Are you a dividend investor? Are you looking to buy your first stock? Watch this video and I'll help you to walk your first steps in the world of dividend investing. First of all, welcome aboard. Thank you for tuning in with me to achieve the ultimate goal, financial independence. I have found my calling to accomplish this certain goal, dividend growth investing. On this channel I post videos for learning and entertainment purposes where I'm open and clear about my portfolio and the decisions I've made so far. Throughout this video I will go over what is a dividend exactly, what are the benefits and drawbacks, understanding how to pick dividend stocks, and at last, although I'm not a licensed financial advisor, I will give some final advice. Without further ado, let's get into it. What is a dividend exactly? A dividend is the distribution of a company's earnings to its shareholders and is paid as a reward for their investment in the company's equity. Dividends are often distributed quarterly and may be paid out in cash or in the form of the reinvestment in their stock. The dividend yield is the dividends per share and is expressed as the dividend divided by the price as a percentage of the company's share price. Common shareholders of dividend payment companies are eligible to receive a distribution as long as they own the stock before the ex-dividend date. According to Steve Greiner, Vice President of Charles Schwab Equity Ratings, they, the dividend payers, often can't compete with the rapid appreciation of fledgling, fast-growing companies, so they use dividend payouts as an enticement. However, in reality, it is usually dividend-paying companies that produce more growth over a long period of time. Dividends, when reinvested, can significantly boost your returns over time, making dividend-paying stocks an attractive option for older and younger investors alike. For example, if you invested $1,000 in a hypothetical investment that tracked the S&P 500 index on January 1st, 1990, but did not reinvest the dividends, your investment would have been worth $8,982. If you had reinvested the dividends, you would have ended up with $16,971,000, nearly doubling your returns. The longer the time frame, the more dramatic disparity. Dividends have played a significant role in the returns investors have received during the past 50 years. Going back to 1970, a whopping 84% of the total return of the S&P 500 index can be attributed to reinvested dividends and the power of compounding. The downside of dividends is that they are not guaranteed. This is important information to consider, as companies can and will stop the dividend if necessary. Market conditions like the financial crisis of 2008 and the 2020 pandemic can create an uncertain environment for dividend-focused companies. In 2020, 68 out of the roughly 380 dividend-paying companies in the S&P 500 suspended or reduced their dividend payouts. Fortunately, companies generally only cut their dividend when they are in distress, so favoring those with sound financial metrics can help mitigate the risk. How to pick a dividend stock. Do not chase high dividend yields. If a company has a high dividend yield, there is always a reason that a security is offering payouts that are well above the average. A good rule of thumb is that before you purchase a high dividend company, those with a 5% yield or more, try to determine why it is so high. Assess the payout ratio. This metric tells you how much the company's earnings are going towards the dividend. The payout ratio is preferred to be under 50 to 60%. This gives the company enough room to grow the company and its dividend. Check the balance sheet. High levels of debt represent a competing use of cash. Under most global security laws, a company must pay its creditors before it pays its dividend. A fast rising level of debt could indicate bankruptcy in the short or medium-term future. Look for dividend growth. Generally speaking, you want to find companies that are not only pay steady dividends, but also increase them at regular intervals. Not only that, but a strong history of regular dividend growth also helps keep pace with inflation, which is particularly valuable to those who wish to seek financial independence and live off of their investments, like me. Understand the sector risk. Some sectors offer a more attractive combination of dividends and growth than others. But there are also different risk characteristics that you should consider when researching a dividend payer for your portfolio. Stocks from banking, consumer staples, and utility sectors, for example, are known for steady dividends and a lower volatility. At last, some final advice. Try to get a clear picture of your horizon, how much you need to invest and what your payment will be in the future when you retire is all relative to your age and what you're able to save during those years. Do not take debt to finance your investments. Your income and lifestyle should be sufficient to fund your investment needs. Good things come to those who wait. Seek feedback. Having a third party provide additional input and opinions on your decisions can work wonders. Join a Facebook group, Discord, or go to a Reddit forum. I hope you guys learned something from this video. Check out my other video where I do an analysis on a stock which just raised their dividend by 39%. Be sure to subscribe to the channel if you haven't already. Thank you for watching and I'll see you guys in the next one. Bye.